I've spent like the last 9 months watching people's eyes just glaze over when I tell them that the most interesting corner of finance right now is insurance. And so for the audience, so you ran American Equity Life, big life insurer, sold it to Brookfield, and you're trying to do something similar-ish at JAB, which is a family chemist fortune, the old Reckitt Benckiser heirs.
It is, yes. 201 years old, though.
201 years old. But you haven't. I wanted you to sort of tell us what you're up to. You haven't talked publicly about this.
Sure, happy to, and nice to be with such a great audience. So you're right, I spent 25 years at the intersection of asset management and insurance. I actually grew up in American Express, and what came Ameriprise out of that, but built a career about being on both sides of a balance sheet, running businesses and then investing. First love was always investing, and so when I took over running AEL 4.5 years ago, I think insurance companies over the last 2 decades really blew it because they sort of unbundled the value chain and got out of investing. And investing is not a business where you outsource. So if you're a balance sheet business, you got to do that. We sold the business. We built a very good model we call the AEL 2.0. It was really the next gen for insurance, which is own your investing outcomes. You know, if you're Apollo, you buy Athene. If you're Athene, you become Apollo. That was the AEL strategy. It was the reverse Athene, if I may use that term. And they've done a great job with their business. But that's what I did then, and now I'm doing something totally different.
Tell us about it.
So it's totally different because I do think asset managers wake up every morning and think assets. I wake up every morning and think about I have a very large pool of permanent capital. It's been around for 201 years. We think in 100-year increments. We have $25 billion from the Ryman family as our primary shareholder, and we want to build, in parallel to our consumer businesses, we want to build an insurance holding company that is a responsible owner of insurance. So we think liabilities first. Liabilities first, backed by permanent equity, not private equity, but permanent equity.
I mean, I think just to unpack this a little bit for the audience, because you know, when you say you come at it from a liability point of view, you know, Apollo, KKR, Blackstone, all the big private equity firms are to some degree in the insurance business. And explain what you mean a little bit about sort of which side of the balance sheet you wake up and think about first. Because there's a way to look at this where insurance, these are life insurance policies and retirement products, which if you squint, just look like giant pots of money that they get now and they have to give back in 50 years and have a lot of time to have a lot of fun with. And so you can see where I'm going with the incentives here, but talk a little bit about how you approach it.
So I'll tell you how I approach it and how I see others do it. There's obviously, insurance overall as an industry got out of investing, so who stepped in? The people who are very good at it. Alt asset managers stepped in. They've done a great job. The names you mentioned are very good at investing. Where we're different in the way we want to approach the space is, at the end of the day, you can be a $1 trillion bank, you can be a $1 trillion asset manager, you cannot make a guarantee. You have to be an insurance company. And in order to make that guarantee, you're a fiduciary to the people we're a Main Street firm. We're not a Wall Street firm. So we will put $5-10 billion of our capital and become a $100 billion insurance company. So every day we wake up, our first $5-10 billion will bear the first dollar loss to back those $100 billion of mainstream promises. Yes, of course, we love investing. We have to then shift to the other side of what do we do with $100 billion? How do you put 25, 30, 40 billion in private assets? But you have to wake up and say, I have to take care of the 100 billion because if I don't, I'm going to lose my own 5-10 billion.
But if I'm a policyholder, I don't wake up in the morning thinking, boy, I really hope my insurance company gets bought by a private equity firm. So if they're watching their premiums go into structured aircraft loans and soccer teams, and I realize I'm picking some fringe cases here, but the average private equity-backed insurer is invested in riskier stuff, right? Yields, higher yields across the portfolio. And the promise seems to be that you can do it without taking any additional risk, just like over time at scale. That doesn't seem possible to me. I just don't totally understand how this doesn't end terribly.
And maybe make 3 points to that. One is, I think the overall asset portfolios, other than sort of the fringe examples, is pretty well managed. I think you don't really get paid in public fixed income markets for risk. Are you better off owning a BBB structured security with only 10 points of subordination underneath you at 150 basis points? I don't think so. So I think some of the structured credit is actually really good for the insurance balance sheet. But I think you really are on a point there, which is about incentives. The incentive structure, though, if it is just to scale for the sake of scaling, ultimately the best investors in the world, what will they tell you? Decision-making units to make a investment decision should be nimble, so you can be opportunistic, and incentives matter. Everybody has a size constraint. You can be the best hedge fund on the planet. You know you cannot invest beyond a certain size. So I think there are pockets of the motivation which is around driving FRE, fee-related earnings, sorry everyone. That's a drug. Avoid the FRE drug if you're in the insurance business.
And this is, to be clear, this is the management fee
Correct.
that Blackstone gets, separate from the profits that they make.
I wouldn't take
investing.
names, but yes.
Sure. But this is the income stream that they've really trained public investors to like, shareholders to like.
Yeah. And insurance is a good business if it's private, in private hands, with permanent capital. If it's, we like being private. I've been in a public company set up for 20 plus years. Yes, we don't have any motivations about growing a fee business.
But most financial crashes, in retrospect, kind of look the same, which is someone built a great mousetrap. Here, it would probably be Apollo, right, who came to this quite early. Everyone copies it. Someone gets sloppy or greedy, and someone does something very dumb, and it ends badly, and people get hurt. So I guess you are sitting here with a blank sheet of paper. Are you worried about bad actors? Because this is going to have to be there's going to have to be some self-discipline in this industry. We'll get to regulation in a second, but are there things going on where you say, don't do that, you're going to ruin this for everyone? I
think you've written very well about one particular example, a lot. So compliments to you of having done it right in terms of things. There are pockets like that. That's not the only pocket. There are pockets like that out there. But there are 2,000 insurance companies, life insurance companies in the US. Think of that, 2,000 life insurance companies. There are going to be pockets where they are not the most appropriate actors. I do believe that there is no alternative to owning your investing outcomes. Think liability-first. Everybody says they do asset liability management. There's a big degree of deviation in practice. And the motivation of growing fees usually ends poorly.
But I think the company you're talking about is 777, which is sort of a pretty fringe case here. I've been buying a lot of very dodgy assets with insurance money. But I think that sort of illustrates the incentives here, which is they look at insurance and they think this is a big pot of money.
Yeah, and it's not sorry to interrupt you, but it's not a cheap funding trade. You should not think if you wake up as an asset person, you say, gosh, I wish I had insurance funding because I could now fund my assets with permanent long-term money for 4 or 5%. That's not the right motivation structure because what are you thinking? How do I fund more and more assets? How do I make more and more fees?
We were just talking to John about this, who was saying, yeah, we do the hard work every couple of years of going to raise a private equity fund, and we think it keeps us disciplined rather than turning on the lights and getting all this money and then figuring out how much fun could I have with this, I think is what you're saying. This has all basically happened without like a peep from regulators. Insurance is mostly state by state. Can that possibly continue the bigger this gets?
The state regulatory system works very well. Like over the last century, you've had very few insurance failures, maybe a little over 24 versus over 500 in banks, right? The regulators are very thoughtful. The key point I would make is that transparency is important, and otherwise the regulatory pendulum will swing violently to the other side and shut out players. By the way, that'll be an opportunity for us. If private equity gets shut out of insurance, that's good for me. Because I'm permanent equity, I'm not private equity. I hope they don't. I think they're responsible actors, but it's an opportunity for us.
But people talk a lot about where's the next crash going to come from, and it's almost certainly not going to be where people are looking or where the last one was. But I just struggle to believe that if a big private equity, if a big life insurer, whether it got there by taking additional risks or not, was about to go under, it would be bailed out in a second.
Yeah, is the sector systemic? I mean, we dealt with that post the last crisis, right? It truly is not systemic if it gets into formation of, it's become an alternative to banks in this whole trend about deep banking and how much credit it provides. You can have a lot of players. Incentive structures will get questioned. You already have regulators in the US in many responsible states, putting restrictions on owners that are very clear about incentive structures. But it varies. It depends on the states.
This sort of land rush and insurance has all sort of happened hand in hand or enabled or been enabled by the rise in private credit. And what you were saying earlier, I think, is that if you're not really getting paid to own a public bond, which is what most insurers over long periods of time have owned, a lot of money has come into that asset class pretty quickly. What's your sense on sort of the intellectual honesty around marks and underwriting and documentation and sort of how all that ends on the asset side of the business you'll be in?
Well, one thing is you could definitely come work with someone like me, because you know the space better than almost anyone I talk to, and I mean that as a sincere compliment. Marks are very important. You have to be all around how you mark these assets. There are pockets of private credit that just don't make sense anymore. Direct lending is a very good example of that. Only pockets of direct lending make sense. Opportunistic credit works. Our cost of funds is, let's just say, risk-free plus 50. If you don't make risk-free plus 400 for the illiquidity premium of going private, we shouldn't be in it. It's harder to make risk-free plus 400 now in direct lending, especially sponsor-backed direct lending, which is why the BSL market or the CLO market doesn't really make sense. CLO is a great example. It makes sense for the asset manager. Why? Because you make fees. And you make fees at the equity tranche. The AAA tranche is just cheap debt. We're not cheap debt. If you're an insurer, you're not cheap debt. And the other part is that, so we're building a private asset manager at JAB that will be only about investing for insurance, vertically owning assets, and we're not going to raise a fee-focused business.
We have time for one more.
Sure.
Insurance is a flavor of this, but I think where all the big alternative players are going for money is into retail. And again, talking about going back to incentives, but how much of these products, it's about suitability, like are they going the right places? Are people being educated? Is everyone going to run for the exits at the same time?
If I knew that, I wouldn't be sitting here with you, but I would say it would be better. The models that work best are the ones where the fiduciary obligation is with the manager. So like if an asset manager should buy broker-dealers, should get into it directly themselves. That model will work well. Retail clients don't understand the illiquidity and are they getting compensated for it. I have seen examples of certain managers shutting down their products and saying, I cannot take more size. That's where I would put money if I was a retail client.
Yeah. Well, that's all the time we have. Thank you so much.
Thanks.